The Philadelphia Federal Reserve just released its Q4 credit card report, and the results are shocking. The fourth quarter of 2023 recorded the lowest performance in card metrics, with delinquencies at all account stages reaching unprecedented levels. The only exception was the 90-plus day balance-based delinquency rate, which remained below its peak from over 10 years ago. Looking throughout the report, it's pretty easy to see that Americans are struggling with credit card debt, with nearly all aspects of the report turning sour. If we direct our attention to this section of the statement, the troubling trends become strikingly apparent. This chart displays the number of customers who are 30, 60, and 90 days behind on their payments. After a significant decrease following 2020, there has been a recent surge in delinquency rates, bringing them to their highest point since the chart started tracking this data in 2012. Additionally, just above the chart, you can see that the report is saying there's a slight increase in median origination credit scores, which is just another fancy way of stating that large banks have tightened their credit card lending standards, anticipating this further trouble. Every possible metric in this area just does not look good. The Philadelphia Fed has developed a comprehensive dashboard that allows you to easily visualize this debt data. Even a brief review reveals clear signs of potential financial distress ahead. For instance, credit card balances have surged dramatically. Back in 2012, the total credit card balance in the US was approximately $584 billion. More than a decade later, this figure has escalated to $911 billion, a 56% increase. Focusing specifically on this recent trend, there has been an astonishing 51% rise in balances from the first quarter of 2021 to the present, highlighting a significant escalation in a relatively short period. This unprecedented surge is really what is worrying people the most, and it's not just that balances are going up, it's that people are struggling to pay this mountain of debt as well. If we switch over to the minimum payment data, you can tell that it's not just that people are taking on more debt because they are making more, people are struggling to pay for these debt increases. The stress among cardholders was further underscored by this payment behavior data, which suggests that the share of accounts making minimum payments rose 34 basis points from the latest quarter's reading. If we take a look at the chart, we can see that the number of people, percentage-wise, just squeezing by is at a high point. Now, it's fair to point out that this chart only goes back to 2012, but regardless, that is over a decade of data, and as you can see, we are well past the high point, headed towards 11%. Revolving balances, or unpaid balances, are soaring, indicating that consumers are facing significant financial difficulties. This concern isn't solely based on federal data. The charge-off rates from credit card companies tell a similarly worrying story. To fully grasp this, let's briefly dwell into what charge-offs mean. A charge-off occurs when a credit card company determines that a debt is uncollectible because the borrower has ceased making payments for an extended period, usually around 6 months. Essentially, the company acknowledges the debt at a loss on their financial statements. Charge-offs are a routine aspect of credit card operations, reflecting the reality that not all borrowed money will be repaid. However, the recent increase in the volume of charge-offs has alarmed many observers. This rise suggests a growing number of consumers are unable to fulfill their financial obligations, which could indicate broader economic distress. Each credit card company, including major ones like Capital One, routinely process charge-offs, but the recent trends could be a signal of deeper financial issues affecting consumers. This Twitter user recently shared a chart depicting the net charge-offs from major banks, including Capital One, Discover, and American Express. As the chart vividly illustrates, charge-off rates are increasing sharply, particularly at companies like Capital One and Discover. After a significant decrease in the post-2020 period, these rates have been climbing rapidly, showing an almost vertical rise towards the end of the chart, signaling no apparent end to this trend. The data, when segmented by age, reveals a distinct trend indicating that financial challenges are particularly pronounced among America's younger generations. This is evident in a chart displaying credit card delinquency rates by generation. In this chart, the most noticeable trend is represented by the red line, which corresponds to the 18 to 29 age group. This line clearly stands out, highlighting their struggle. Following closely is the gray line, which marks the fastest increase in delinquencies and represents individuals aged 30 to 39. Take a listen to this recent CNBC report, which highlighted these problems a few months back, showcasing the serious issues unfolding in the credit card space, especially among America's young people.
While consumer debt levels are rising across the board. One group in particular is having a very hard time repaying that debt. Sharon Epperson joins us now. She's got the story for us. Sharon.
David, even though the increase in delinquencies can be seen across income groups and regions, it is disproportionately driven by millennials, especially those with auto or student loans and those with relatively higher credit card balances. Millennials have the largest share of credit card delinquencies. Those borrowers who are newly late on their payments now exceed 2019 levels before the COVID-19 pandemic. All other generations are at or near their 2019 averages. Now, many millennials came into the workforce during the 2008 Great Recession. They experienced the housing bust and then boom. High rates of student loan debt have made it harder to buy a home and stabilize their housing costs. They're also in the time of life when they may be working to buy a house, have children, and save for college all at the same time.
It's been a difficult time for millennials as well, who are in kind of this really expensive time in their lives. It's not hard to see where millennials would be struggling more than some other groups when it comes to making those payments.
Given all the challenges in this sector, you might be wondering why this isn't a bigger story. The data clearly shows that serious debt issues are affecting consumers, particularly young people, and credit card companies are openly reporting an alarming increase in charge-offs. It's particularly puzzling considering the robust performance of their stock prices. What is going on? This discrepancy raises more important questions about the broader financial landscape and market perceptions. For example, Capital One. The stock is approaching all-time highs, and its performance this year has been excellent. Since the start of 2024, the stock has jumped nearly 13%, outpacing the S&P 500 by nearly 2x. Given the fact that there are thousands of expert players in the markets analyzing and reanalyzing every detail regarding these companies, how could it be that they missed something big like this? Well, the unfortunate answer is they didn't. Investors are well aware of the growing charge-offs in this sector. If we take a look at Capital One's last earnings report, we can see that during that call, the word charge-off was said over 30 times. It's not exactly a secret. What is happening is pretty clear once you read the transcript. When questioned about these concerns, the CEOs of these companies suggest the delayed charge-offs theory. What this boils down to is this. During the pandemic, usual consumer behavior was altered due to the stimulus packages and forbearance measures, which temporarily prevented some expected charge-offs. The CEO, particularly in the Capital One case, believes that while some charge-offs were avoided permanently, others were merely postponed. This phenomenon of delayed charge-offs isn't easily quantifiable, but it is seen as a factor in the ongoing process of returning to normal financial operations. The CEO also mentions that recovery rates on charged-off debts have remained strong, although the total volume of charge-offs was low due to the pandemic's effects. Now, as economic conditions stabilize, charge-off volumes are beginning to increase, which should level off as time goes on. Essentially, because of this large dip right here, we're going to have a pretty big bump right now, and going forward, we should level off and have a normalized rate in the long term. That is the general consensus, and the market believes it. That's why a lot of these credit card companies are doing great if you look at their stock price as a report card. Even the Federal Reserve doesn't seem too concerned. A recent report by the St. Louis Fed shows that while yes, credit card debt has surpassed $1 trillion, when looked at through the lens of disposable income, credit card balances are essentially equal to what they were in 2020. Who to believe is up to the individual, but it's pretty clear that a large portion of the experts are not concerned and have attributed this recent rise to the rebound effect. Ultimately, with the unemployment rate still hovering near all-time lows, it will be very hard to convince anyone that there is serious trouble in the market. Until these numbers begin to move up in a significant way, the prevailing consensus will always be that Americans will find a way no matter how high the debt mountain gets. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments below what you think of the American credit card problem.